Did you know a recession again would lead our lives to more sorrow? Have you ever imagined what causes the recession? Is it just because of the banking failures, or is it the result of other economic events in a country? Does recession have a global effect on all industries, or does it just affect financial businesses? Let us see what makes the recession and what effects they have on our lives. Since the Industrial Revolution, most economies have developed steadily, and economic contractions are odd, although recessions are still expected. Between 1960 and 2007, 122 recessions impacted 21 advanced economies around 10% of the time, according to the International Monetary Fund. Recessions have evolved less routine and don't last as long in current years. The declines of financial output and unemployment that recessions force can evolve self-perpetuating. A recession is an influential, widespread, and long downturn in an economic stir. A standard rule of thumb is that 2 straight quarters of negative gross domestic product growth means recession, although more complicated formulas are also employed. Economists at the NBER, or the National Bureau of Economic Research, pushing far beyond the more superficial 2 quarters of negative GDP measures. Since the Great Depression, governments worldwide have adopted fiscal and monetary policies to prevent a run-of-the-mill recession from worsening. Some stabilizing aspects are automatic, such as unemployment insurance that sets money into the purses of employees who mislaid their jobs. Other bars need specific actions like slicing interest rates to boost investment. Recessions are usually undoubtedly recognized only after they're over. Investors, economists, and employees may also have distinct experiences concerning when a recession is most flawed. Equities markets often decline before an economic downturn, so investors may assume a recession has begun as investment losses accumulate and corporate earnings decline, even if other recession measures remain healthy, such as consumer spending and unemployment. While there is no single surefire predictor of a recession, an inverted yield curve has come before each of the 10 US recessions since 1955. However, not every period of the inverted yield curve was followed by a recession. Short-term yields are lower than long-term yields when the yield curve is normal. This is because longer-term debt has more course risk. The rise of near-term interest rates can tip the economy into a recession. The yield on long-term bonds drops below short-term bonds because traders expect near-term economic frailty to lead to eventual interest rate cuts. Investors also look at a mixture of leading indicators to herald a recession. These comprise of the ISM Purchasing Managers Index, the Conference Board Leading Economic Index, and the OECD Composite Leading Index. Numerous economic theories explain why and how an economy goes into a recession. Some theories say financial factors force recessions. These theories concentrate on credit growth and the usurping of financial risks during sound economic times, the compactation of credit, and the money supply when a recession initiates. Monetarism, which states recessions are caused by insufficient growth in the money supply, is a good example of this type of theory. To explain why recessions transpire and continue, other theories focus on psychological factors, such as overexuberance during economic booms and serious dismay during downturns. Keynesian economics concentrates on the psychological and economic factors that can fortify and prolong recessions. The notion of the Minsky moment merges the two to explain how bull market ecstasy can boost unsustainable hypotheses. In 2020, the COVID-19 lockdowns and other government actions in early 2020 drove the global economy into a recession, the second largest global recession in recent history. Within a couple of weeks, global markets have evolved restless concerning the banking sector after a string of disturbing occurrences that triggered the doom of Silicon Valley Bank, the largest bank failure in the US since the 2008 economic crisis. US controllers have brought over SVB and Signature Bank. Over the weekend, Credit Suisse was purchased by UBS, the country's amplest bank, a sale totaling more than $3 billion, which desired to thwart a failure in Switzerland. For some, the agitation among banks has returned resemblances of the 2008 financial crisis, directing queries about whether we're steering into another protracted recession. But economists say this time is unlikely, and alert against likening the banking failures to those of 2008. Controversies and scandals have plagued Credit Suisse in recent years. Still, a statement from the chairman of its biggest investor, the Saudi National Bank, on March 15th, days after the Silicon Valley and Signature Bank failures, forced investors to alarm last week. Ammar al-Qadari stated that the Saudi-backed bank would not increase its stake in Credit Suisse, partly because that would put its holdings above 10%, which would concern other regulatory provisions for the investor. The statement evoked Credit Suisse shares to drop. Last week, an about $54 billion loan offer from the Swiss central bank did not adequately shore up the faith of the banking giant, regarded as one of the 30 global banks supposed too systematically critical to be permitted to fail. Controllers organized a deal with UBS to thwart what could have been one of the greatest banking failures since the 2008 fall of Lehman Brothers. "It's a shotgun wedding," states Kathy Bosjancic, Senior Vice President and Chief Economist of Nationwide Mutual. Before the UBS confiscation, Credit Suisse had lost more than a quarter of its stock market worth since the beginning of 2023, and more than 70% in the past 12 months. At the end of 2022, the bank allocated a profit warning, declaring that clients had withdrawn billions of dollars in the fourth quarter. The UBS purchase and following stabilization of Credit Suisse may not thoroughly settle the tensions in the financial markets, as investors may be nervous about forthcoming failures. Still, controllers' swift action should help satisfy concerns. The sale shows how much controllers have realized from the oversight of the global economic crisis, and how much better prepared they are now. They're lugging much more swiftly than they did previously, which gives them greater potential to contain the banking crisis. While it's challenging to anticipate if and when another shoe could drop, it does ease many concerns that this is turning into a systematic event. In the issue of Credit Suisse, AT1 bondholders saw $17 billion worth of these bonds wiped out and written down to zero before stakeholders took a hit, which is unusual in this type of scenario. Debt, including bonds, typically ranks above equity or stock in the event of financial distress and heightened scrutiny from regulators, investors, and depositors. Last week, a group of 11 of the US's largest banks rushed to restore confidence in First Republic Bank, pumping in $30 billion worth of deposits, with JP Morgan Chase, Citigroup, Bank of America, and Wells Fargo each making a $5 billion uninsured deposit into the bank. According to Wall Street Journal, some big banks are reportedly discussing a further capital infusion into the First Republic. With inflation stubbornly high, governments worldwide have been working to prevent recession, but it's a hard balance to strike. In the Federal Reserve's case, it has been gradually increasing interest rates, raising the cost of borrowing, and discouraging consumer spending. Banks have underwriting standards, which helps determine who to lend money to. Still, it could contribute to a recession if they become concerned about lending risks, making it harder for businesses and individuals to borrow money. If local banks become more conservative about who they make loans to, it could lead to less demand, fewer sales, and delaying economic activity. Is it serious enough to force a recession by itself? We think not, and certainly not nearly as serious as what happened in the global financial crisis. Markets will closely watch the Federal Reserve's interest rate decision on Wednesday. Despite the current bank rate, economists have indicated it will continue to raise rates, with a 1/4 percentage point hike forecast. On Monday, European Central Bank President Christine Lagarde welcomed Switzerland's swift action on Credit Suisse, but did not indicate any change in the central bank's interest rate plans. "We are using our interest rates, which was the issue last week. This was our point before, because we hold enough base to protect to move at our pace." The central bank increased rates by 1/2 point last week. While some economic predictions imply the probability of a recession has increased, economists don't anticipate it to be on the same hierarchy as the Great Recession, which endured from late 2007 to 2009. Goldman Sachs is now predicting a 35% probability of a US recession in the following 12 months, up from its earlier prediction of 25%. Oxford Economics expects a gentle recession will arrive this year, mainly due to the Fed's too assertive in increasing interest rates. Currently, households, corporations, and local governments are flush with cash. That should help limit the severity and duration of the recession. And it has also aided that controllers have acted swiftly in Switzerland and the US. The Economist states that the recent banking agitation is not a crisis but a point of terror, and that brief action from Swiss regulators suggested that the economy is not fronting anything close to the scale of the banking crisis in 2008. Is banking failure the primary reason, or do other factors have a large impact on these causes? Comment below if you've faced the concerns of a recession before, and what are you guys trying to set yourself out of this crisis? Until next time, goodbye.